Banking services are essential financial services provided by banks to individuals, businesses and other institutional clients, including deposits, loans, wealth management, currency exchange and investment banking. Stay tuned as we go into great detail about banking. For more videos like this, don't forget to click the likes and subscribe buttons on our channel. The term bank can be used to describe a wide range of financial establishments, including credit unions, savings and loan associations, commercial banks, investment banks, community development banks, digital banks, and any other financial institution that accepts deposits. Ancient banking. The earliest documented cases of banking can be found in ancient times, where farmers and merchants employed grain and other commodities as a form of exchange. Coins were created to enable trade, and it serves as a form of currency around 2000 BC. The Romans established banks as a formal institution and permitted bankers to take over land as security for loans. Medieval banking. Many academics believe that the origins of the contemporary banking system may be found in Italy. Throughout the Middle Ages and the Renaissance, specifically in the wealthy towns of Florence, Venice and Genoa. In the 14th century, the Bard and Pruzzi dynasties controlled the banking industry and opened offices across most of Europe. The Medici Bank, founded by Giovanni Medici in 1397, was the most well-known bank in Italy. Bank Monte dei Paschi di Siena, with its headquarters in Siena, Italy, is the oldest bank still in existence. The bank has been in continuous operation since 1472. In order to print money and control the national debt, Sweden founded the first modern central bank in 1668. Modern banking in the 20th century saw significant changes to the way banks operated, as well as a dramatic expansion in their size and geographic reach. Many banks failed during the financial crisis of 2007 to 2008, including some of the biggest banks in the world. This sparked intense discussions over bank regulation. Global banking asset in 2021 was $183 trillion. This is a significant sum of money, more than the global GDP, which is $100 trillion as 2022, as reported by Statista. How are these resources split up across various nations and regions? In fact, the Asia-Pacific region accounted for 45% of all worldwide banking assets in 2021, according to McKinsey's Worldwide Banking Annual Review. China dominates this region, accounting for 28% of global banking assets, followed by Japan with 7%. With 25% of worldwide banking assets in 2021, Europe is the second largest area, followed by North America with 19%. Only 11% of the world's banking assets come from the rest of the world. S&P Global Market Intelligence reports that Industrial Commercial Bank of China Ltd had total assets of $53 trillion as of December 31, 2021, making it the largest bank in the world by assets. With assets of $46 trillion, China Construction Bank Corp. was the second largest bank. In fact, 4 of the top 5 banks in the world by assets are Chinese banks, demonstrating the nation's strong financial position and rapid economic development. JP Morgan Chase is the biggest bank in the US and the 5th biggest bank in the world. HSBC Holdings plc is the 6th biggest bank in the world and the largest in Europe. There are approximately 15 million bank branches and 35 million ATMs operating globally, according to IMF statistics from the Financial Access Survey. But this figure does not accurately reflect the variety and complexity of banking services or the effects of digitalization and innovation over the past 10 years. Chinese banks have significantly increased their global presence, particularly in emerging markets and developing economies, and these banks are responsible for about 75% of China's claims against emerging markets and developing economies, and more than 35% of its claims against borrowers globally, according to the Bank for International Settlements (BIS). In the BIS location banking statistics as of mid-2021, Chinese banks reported claims on 175 of 185 borrowing jurisdictions, accounting for around 75% of global cross-border bank lending. Their international lending is crucial for EMs in particular because Chinese banks with a market share of more than 26% record bank claims on 133 out of 143 EMs. In actuality, more than any other financial nation, 63 EMs already borrow money from Chinese banks, central banks, by enforcing banking regulations and implementing monetary policy. Central banks have an impact on the world economy through open market activities. They have an impact on interest rates and the money supply, which has an impact on borrowing and lending costs as well as the degree of economic activity. They also function as the lender of last resort when necessary, and determine the reserve ratio for commercial banks. Economic and monetary policy as well as the stability of the financial system is under the control of central banks. They determine interest rates and manage a nation's money supply. Some of the world's largest economies and their central banks must balance managing inflation with preventing a recession. There are numerous ways that central banks can fail. For instance, the financial crisis of 2007 to 2008 nearly brought about the collapse of the global financial system. This led to the failure or near failure of a number of major investment and commercial banks, mortgage lenders, insurance companies, and savings and loan associations, and sparked the worst economic downturn since the Great Depression. The Great Recession 2007 to 2009, determining whether the unfolding events were caused by counterparty risk, resulting from asymmetrical knowledge about the quality of assets on bank balance sheets and the opaque nature of those balance sheets, was a crucial concern for central banks. Today's world presents a lot of difficulties for central banks. The need to preserve financial stability while still fostering economic growth is one of the largest issues. In a situation of low interest rates and strong inflation, this is extremely challenging. The requirement to preserve central banks' independence presents another difficulty, since central banks are frequently regarded as stewards of monetary policy. It is crucial that they continue to operate independently of politics. The final challenges brought on by technological progress are also experienced by central banks. The emergence of digital currencies and other new technology has forced central banks to change the way they conduct business in order to compete in the modern economy. Credit unions. Credit unions have a long history that dates back to Europe. In the 19th century, Franz Hermann Schultz Delitzsch founded the first credit unions in Germany in the 1850s. These credit unions were established to provide those without access to financial services with the chance to borrow money from the savings that they and their fellow members had amassed. Credit unions have now proliferated throughout the world, and the World Council of Credit Unions was founded in 1970. Giving their members a place to handle their funds under the best conditions is the credit union's main goal. Credit unions were founded to benefit their members and the community as non-profit cooperatives promoting financial inclusion. Savings and loan associations. Savings and loan associations are businesses that focus on lending money to their members or clients in the form of mortgages. They are frequently owned and run by their shareholders or members who have voting rights and can affect the organization's objectives. Making residential mortgage loans is the main function of savings and loan organizations. The goals of savings and loan associations include giving consumers a secure location to save money, funding for house purchases, and fostering community growth. Digital bank. Digital banks don't have any physical branches or offices. They do all of their business online. They provide customers with a variety of financial services including deposits, loans, payments, transfers, investments, and more via online channels like chatbots, mobile apps, and websites. Neobanks and fintech banks are other names for digital banks. In recent years, digital banks have become more and more common, particularly among younger tech-savvy consumers who value convenience, speed, and personalization. Digital banks, up from 11% in 2017, accounted for 25% of newly established current accounts in Europe in 2022, according to a McKinsey report. By the end of 2022, digital banks in the US had more than 50 million customers, a tenfold increase since 2015. Investment banks. Investment banks are banking institutions that assist governments and businesses in raising funds, by issuing and reselling securities. They also offer consultation services for various financial transactions, including mergers and acquisitions. Through their facilitation of the transfer of capital between investors and businesses, investment banks play a significant role in the world economy. They assist businesses in raising capital for investments to grow and other initiatives that might stimulate the economy. The front office and the back office are the two main departments that investment banks normally have. The front office job is to carry out financial transactions with clients in order to generate money. The back office offers assistance with things like risk management, compliance, and operations. Commercial banks. Commercial banks are financial institutions that offer banking services to both private citizens and corporate clients. They issue loans, receive deposits, offer checking and savings accounts, and offer other financial products including safe deposit boxes and certificates of deposit. Most people conduct their financial business at commercial banks. Commercial banks generate their income through service charges and interest on loans. They'll lend borrowers who require funds for various purposes the money they get from deposits. A bank pays interest on its deposits at a lower rate than the interest rate it charges on loans. The interest rate spread is the primary source of income for commercial banks. Community development banks. In the 1970s, community development banks were inaugurated as community development credit unions and banks. Shore Bank was established in Chicago in 1973 and quickly became one of the most well-known community development banks. The primary goal of community development banks is to foster economic growth in low to moderate income geographic areas and provide services to the residents of these communities. Usually this is because such areas are home to lower income residents who are not seen as appealing to major banks. Communities that are underserved by banks are given access to credit payment and savings options through them. They also offer finance to small firms that are not profitable enough to draw the attention of the investment banking and traditional commercial banking sectors. Banking crises. A financial crisis that affects banking activity is referred to as a banking crisis. Bank panics are the crises which affect numerous banks. Banks run affect only one bank, and a systemic banking crisis is when numerous defaults occur and financial institutions and businesses have a difficult time fulfilling their contractual obligations. A variety of dangers can affect banks. This includes the risks of credit loans and other assets failing to perform, liquidity withdrawals exceeding available funds, interest rates rising. Interest rates depreciate the value of bonds held by the bank, forcing it to pay relatively more on deposits than it receives on loans. A decline in the value of banks' assets is frequently the cause of financial issues. This might happen as a result of a decline in real estate values or a rise in non-financial sector bankruptcies. For instance, if a government defaults on its obligations, the value of the bonds that banks hold in their portfolios may drop significantly. Banks may have obligations that are greater than their assets as a result of a significant decline in asset values, which would indicate that the bank has negative capital or is insolvent. The bank may still have capital, just not to the minimal level required by law. This is also referred to as technical insolvency. If a bank has too many liabilities that are due, and is short of cash or other assets that can be quickly converted to cash, this can also cause or exacerbate financial troubles. This may occur, for instance, if a large number of depositors attempt to withdraw funds from the bank at the same time deposits run on the bank. It might also occur if a bank's debtors want their money back but the bank is short of funds. Illiquidity and insolvency are two different concepts that must be understood. For instance, a bank may be solvent but illiquid, i.e., possess adequate capital but insufficient cash. However, insolvency and illiquidity frequently go hand in hand. Depositors and other banks' borrowers frequently become nervous and demand their money back when there is a significant decrease in asset values, which exacerbates the bank's problems. Numerous banks across the nation can have severe solvency or liquidity issues at once. This may be as a result of all affected by the same external shock or as a result of one bank's or a group of banks' failure spreading to other banks in the system. This is known as a systemic banking crisis. A systemic banking crisis, in more precise terms, occurs when there are a lot of defaults in a nation's corporate and financial sectors, and when financial institutions and businesses have a hard time meeting their contractual obligations on time. As a result, the amount of non-performing loans spikes and the total capital of the banking system is nearly depleted. Depressed asset prices. Following the run-up prior to the crisis, substantial increases in real interest rates and a slowdown or reversal in capital flows may all be present in this scenario. A depositor run on a bank may cause a crisis in some instances, but most often it is the broad realization that systemically significant financial institutions are in trouble. Regulatory responses to bank crises. In order to forestall, reduce and mitigate the impact of bank crises, the regulatory authorities in various jurisdictions always come up with various measures which may include the following. Providing liquidity support. This means that banks that temporarily need cash but are otherwise sound are given emergency loans or guarantees by the central bank or the government. By doing this, bank runs can be avoided, and banking system trust can be rebuilt. The Federal Reserve recently made a $25 billion bank term funding program announcement to assist small and mid-sized banks that were experiencing liquidity issues as a result of higher interest rates and a slowdown in the tech sector. Recapitalizing or restructuring banks. This means that in exchange for equity stakes or other kinds of payment, the government injects cash into banks that are insolvent or undercapitalized. This can safeguard depositors and creditors as well as help banks regain their viability and solvency. During the global financial crisis, for instance, the U.S. Treasury established the Problematic Asset Relief Program (TARP), which offered $700 billion to purchase problematic assets or shares from banks and other financial firms. Resolve or close failed banks. This means that when a bank can no longer be repaired or poses a systemic risk to the financial system, the government will step in to take over, sell, merge, or liquidate the bank. This can lessen moral hazards and cut back on taxpayer losses. In the U.S., for instance, insolvent banks are resolved by the Federal Deposit Insurance Corporation (FDIC), which compensates insured depositors and sells or liquidates the bank's remaining assets and liabilities, in order to ensure bank safety and soundness and compliance with laws and regulations. The government imposes norms and standards on them. By decreasing excessive risk-taking, increasing transparency and accountability, and fostering financial stability, this can help prevent or lessen future banking crises. For instance, numerous nations established stronger laws regarding bank capital, liquidity, leverage, stress testing, resolution preparation, consumer protection, and other elements of banking activity during the global financial crisis. Banking and technology. Some cutting-edge technology has been adopted in the banking industry globally to deliver efficient and effective service to their various customers. These technologies have assisted the banking industry in recent years to be efficient in their operations. Let us examine the impact some of them are making on global banking operations and services. Blockchain technology is a decentralized ledger system technology that makes secure and open transactions possible. Blockchain technology is currently being used by banks to enhance their payment processes and lower transaction costs. The financial sector is also being transformed by artificial intelligence (AI). Banks now use AI-powered chatbots to offer help and customer care. These chatbots can offer personalized recommendations based on consumer data and respond to client questions in real time. In the financial sector, machine learning is also quite important. Banks are using machine learning algorithms to analyze consumer data and offer individualized financial guidance. With the use of this technology, banks are able to provide services that are more suited to the demands of their clients. Technology has improved efficiency, speed, and convenience, among other things, but it has also created certain problems. Cybercrime is one of the biggest problems brought on by the usage of technology. Banks are greatly threatened by cybercrime since it can result in the theft of money and private data. To protect the data of their customers, banks have had to make significant investments in cybersecurity measures. The loss of jobs is another issue. Many banking processes have been automated as a result of technological adoption, which has resulted in employment losses. Since it has resulted in high unemployment rates, this has been a serious concern for many individuals. Technology adoption has enhanced competition in the banking sector. Because of the growth of fintech businesses, traditional banks now have to compete with them for customers. As a result, banks are under more pressure to innovate and develop new goods and services. If you enjoy this video, give it thumbs up and share it with your friends so that we can keep making them. For more videos like this, hit the subscribe button and remember to click on the notification bell so that you get notified when we post a new video. Thanks for watching.